Hello everyone. In this chapter, I am going to teach you about the um, banking system of India. So, word banking was derived from the Italian word banco, meaning bench. Now, history of India in banking in India is can be divided into three phases. Phase one was the pre-independence era. It was from 1700 to 1947. In that, the first bank which was formed was the Bank of Hindustan, and then it was closed in 1832. So Bank of Hindustan was from 1770 to 1832. Then Bank of Bengal formed in 1809. Then Bank of Bombay formed in 1840, and Bank of Madras formed in 1843. All these were called the Presidential Bank by East India Company, and then all this merged in 1921 to form the Imperial Bank of India, which later on became nationalized to form the State Bank of India in 1955. Now, after that, in phase two, post independence period from 1947 to 1991, the nationalization of bank under Banking Regulation Act happened in 1949. In the first phase of Banking Regulation Act, 14 banks were nationalized in 1969 and six other banks were nationalized in 1980. After this, the third phase of the history of banking happened, which is known as the liberalization phase, which is still now going on from 1991 to till date, and it is following the report of Narasimha Committee of December 1991. Now let's look into types of banking. There are 12 types of banking. First is unit banking. It is a singular bank branch having all the doing all the functions. Second is branch banking. It is same bank having multiple number of branches. Third is correspondent banking. It is basically a bank which acts as a middleman to accomplish transactions on behalf of another financial institution. Fourth is group banking, in which two or more independent banks work under the control of a single holding company. Fifth is pure banking. Banking is when only short-term loans to industry, trade, and commerce is given, and no other functions are there. Sixth is narrow bank. It is like a bank, but it has a restricted number, like very few minimum banking activities are there. Seventh is relationship banking. Eighth is universal banking, bank which has all the functions a bank should have. And ninth is wholesale banking. It is for huge companies. And then this private bank, it is only for people, a certain number of people, and like private only for certain number of people, like who have high liquidity. And 11th is retail or consumer or personal banking. 12th is core banking. It means that anywhere bank, like banking from anywhere, like from the same bank. For example, different branches of SBI. From anywhere we can access to the same bank. And core, the full form of core is centralized online real-time exchange. Now, uh, yeah, this is the basic Indian banking system's flow chart. The first division in Indian banking structure is there is an organized sector and there is an unorganized sector. The organized sector follows the rules set up by RBI, and unorganized sector is made up of money lenders and unregulated. It is unregulated. The organized sector has three parts: commercial banks, cooperative banks, and development financial institutions. The commercial bank has two parts, scheduled and non-scheduled. Cooperative banks are basically the banks which belong to the member who are the owner and customer at the same time. And development financial institutions are the institutions, they basically provide funds for capital projects or like to borrowers who are unable to take commercial loans. There are five DFIs in India: NABARD, SIDBI, NHB, EXIM, and NAFID. Now, uh, the parts of commercial bank are scheduled and non-scheduled. Like schedule are the one who are listed in the second schedule of RBI Act 1934, and they enjoy specific privileges, and also they adhere to specific regulations, and minimum paid of capital and raised fund should be 5 lakhs. and non-scheduled are the ones who do not come in the second schedule of RBI Act 1934. Now, scheduled banks can be divided into two parts: public sector banks and private sector banks. Public sector banks are government owned, and private sector banks are owned by private individuals. Public sector banks has three parts. First is SBI, since it is the largest PSU and it has its own act and legislature, SBI Act 1955. So it has a different like altogether uh, different part between the public sector bank, and also it has like its associate banks are there. They include State Bank of Bikaner, State Bank of Jaipur, State Bank of Mysore, State Bank of Travancore, State Bank of Hyderabad, State Bank of Patiala. Next are nationalized banks. These are national like banks which are owned by Government of India, like PNB, Bank of India. And third are RRBs, regional rural banks. RRB Act, like these are the banks coming under the RRB Act of 1976. And this act was given by M. Swaminathan, and he is also known as the father of RRBs. Now, moving to private sector banks, which are owned by private individuals, they can be divided into domestic private banks and foreign private banks. The difference is simple. The domestic private banks are the banks which operate within the country of the like within the domestic boundary of the country, and private bank they have headquarters in some another country, but they do have presence in our own country. Now, domestic private bank have three kinds. First is universal private bank. They give wholesale, retail, and investment service, all kinds of service at one place. Second are differentiated banks. These were actually recommended by Nachiket More Committee in 2014, and these include banks. Payment banks are the banks who cannot give loans, but they can invest their funds in GSECs up to 2 lakhs, and also cannot issue credit card, but can issue debit card and ATM card. And yeah, I think that much is important. And also, they include payment banks and small finance banks. Small finance banks are for small business, farmers, and all that. So these are the two included in differentiated banks. Third are local area banks. These are the banks which operate within maximum two or three district or towns. And example is Coastal Local Area Bank Limited and Krishna Bhima Samruddhi Limited. That is all. Now going above, we had done the types of banking. Now, functions of banks. There are three major functions: primary function, secondary function, and miscellaneous function. Primary functions is acceptance of deposits, loans, and advances. Secondary functions is they can act as an agency function or utility function. Miscellaneous are they can provide bank guarantee, letter of credit, and underwriting and credit guarantee facilities. We will study each of this in more detail. Like banks have two kinds of deposits. They have demand deposits and time deposits. Demand deposits are the deposits in which a person can withdraw any amount at any time, and time deposits are it cannot be withdrawn before the ending of the fixed tenure. Demand deposits have saving account and current account. Saving account, low amount of interest is given, while in current account, no interest is given, but an overdraft facility is there that a person can actually take out more money than it is present in the current account. For example, an overdraft of 1 lakh is there. So even if you spend all your money, yeah, even in excess, you can take up to 1 lakh money from the bank account and you can later on repay it. Time deposits are fixed deposits and recurring deposits. Fixed deposits are submitted at once and recurring are paid from time to time. Now, there are three kind of bank accounts to promote global trade. First is Nostro account. This is basically an account of, for example, account of a domestic bank held in foreign country. For example, if SBI has an account in HSBC Bank in UK. Second is Vostro account. It is held by a foreign bank in India, and also as it is held in India, it is maintained in rupee. For example, account of HSBC in SBI in India. Lotto account is domestic bank has a bank account in foreign country and clears the due for a foreign trade on behalf of a third party bank. Like for example, SBI clears the due of ICICI Bank with his with the account of SBI with HSBC in UK. Like if SBI has account with HSBC in UK, that is a Nostro account. So basically, with the help of SBI's Nostro account, if ICICI Bank clears its due, then this is known as the LORA account. Okay. Now this is done. Okay. Now, there are two kinds of credit facilities. Basic first is fund-based lending. Second is non-fund-based lending. Fund-based lending can be short-term loans and long-term loans, and non-fund-based lending is bank guarantee facility, letter of credit, and underwriting and credit guarantee facilities. So basically, you can understand that all of this don't involve no real transfer of cash, and we will learn about this in detail now. Yeah, bank all these credit facilities come under the miscellaneous part, and we did the primary functions, like it was easy to understand. And now secondary functions we will do. So secondary functions, yeah, first is agency functions, second is utility functions. Secondary functions are agency functions are basically transferring funds, periodic collections of fund, periodic payment, collection of check, portfolio management, like all the issues except the maintenance of accounts and the miscellaneous part. These all are included in agency functions. Utility functions are issuing letter of credit and dealing in foreign exchange. Now there can be many types of check. There are seven kinds of check. First is bearer check, like whoever has the check can get the money encashed. Second is order check, like only the payee whose money is given, like written in the check, can take that money, and whoever is the drawer of the check, they have to strike the or bearer written in the check. Third is cross check. There is no cash withdrawal, and they have to draw two lines at the top left corner like this, and then they have to like drop the check, and whoever's name is written in the check gets the money in their transferred in their bank account. Fourth is amount account pay check. No third party is required to transfer the cash. In this, two top lines at the left corner, just like the cross check is drawn, and then between those two lines, account pay is written. And like I can drop the check in your name, and you may get the money transferred into your bank account. Stale check is if withdrawal of check is after 3 months. Post dated check is if I like drop a check now and the date was earlier, and from that date 3 months will be counted. Antedated check is if I drop a check. No, actually, I just said the opposite. Antedated is if the date is earlier than now, and post dated is if the date is later on from today. Yeah, that is all. Now there are types of ATMs. There are eight types of ATMs. White label. White label are for like owned and operated by non-bank entities, NBFCs. Second are brown label ATM. They are owned by banks but are operated by third-party service providers. Third are green label ATMs. They are for agriculture transactions. Orange label ATM for share transactions. Yellow label for e-commerce transactions. And pink label ATM that promote women in banking. On-site ATMs are the ATMs which are present inside the compound of bank. Off-site are the present outside the compound of bank. The miscellaneous functions of banks, yeah, we did the primary functions, secondary functions, and now we will do the miscellaneous function. The miscellaneous function was to bank guarantee and letter of credit. Bank guarantee is basically a guarantee. For example, if I'm a person, like, no, consider there is a person X and there is a person Y. Now person X owes rupees 100 to person Y, and now person Y goes to, or like I think person X goes to bank and asks bank to give letter of give bank guarantee to person Y that he will pay the money back to person Y, and like he will pay the money back to bank after that. Wait, okay, so let me just draw it. Okay, assume that is person X and this is person Y. This is the bank. Now in first stage, person X owes person Y rupees 100. N- But now, right now, person X cannot doesn't have the fund to give rupees 100 to a person Y. What he does is he gives a bank guarantee to person Y. Now, what is bank guarantee? Person X has already had a talk with the bank that he will pay, that the bank will, that if he is not able to pay, then the bank will pay to person Y for the rupees 100. Now person Y goes and gives the bank guarantee to the bank, and then provide the bank gives rupees 100 to person Y, and then Y has already got his fund, and later on, after the specified amount of time, the person X gives the rupees 100 to the bank. Now why will bank do this for person X? Based on his previous, uh, earlier, was he able to pay back his loans on time and all that? Based on these things, the bank will give a bank guarantee. So that's not erasing. Okay. Yeah, that is all. Now next is letter of credit. Now what happens in letter of credit is that you see, this is the image. Now this is Mr. X and this is Mr. Y. Mr. X has to give money to Mr. Y, and he is not of this country. Okay, he is from some foreign country, and for that, he does is Mr. X approaches a domestic bank in his own country, which is Bank of India in this case. What Bank of India does is Bank of India gives a letter of credit to Bank of England, and then Bank of England uh, trans tells this to ba- basically Bank of India gives a letter of credit to Bank of England, which is the advising bank from Mr. X. Now Mr. X will say this provide this bank of letter of credit to the nominating or negotiating bank, and the negotiating bank will provide the money to Mr. Y. And then the negotiated bank having this bank of letter of credit will go to the opening bank, and then opening bank will give the money on the date of date of return to the negotiating bank. So negotiating bank also gets their money back, and this is how letter of credit is happening. So what is happening here is Mr. X is giving Mr. X is approaching Bank of India, and then Bank of India is giving letter of credit to Bank of England, as bank can transfer letter of credit between them, and then that Bank of England is advising Mr. Y that they has got a letter of credit, and upon this certification, upon this verification, Mr. Y transfers the goods whichever needed to be delivered, and after this, Mr. Y approaches the negotiating bank with the letter of credit, and then the negotiating bank, after verifying the letter of credit, gives the money to Mr. Y. And after the due date, the negotiating bank goes with the letter of credit to the opening bank and asks for the money, and then the opening bank com- completes the transaction by giving them the money. This is what it happens. And letter of credit is also known as documentary credit and non-fund based credit. And also in this, Mr. X and Mr. Y both are unknown of each other. They do not know each other, and they undergo the whole transaction by interacting with their own bank branches in their own domestic country, which is opening bank for Mr. X and advising bank for Mr. Y. Also, this reimbursing bank can be there, which is appointed by the opening bank to reimburse in case reimburse to the negotiating bank in case Mr. X fails to get the money. Third is underwriting agreement. This is also a miscellaneous function of act, like in which one party agrees to fulfill the deficient money for another party. It is kind of a credit guarantee form of insurance that protects seller from chance of non-payment. Yeah. Uh, okay, so moving on. Mortgage. Mortgage can be of a land or building or for any immovable property when they are given as a security for taking a sum of loan. And it comes under the Property Act 1882 and SARFAESI Act 2002. There are five types of mortgage. First is simple mortgage, in which the ownership remains with the borrower. Second is mortgage by conditional sale, in which if they default in the payment by the specified amount of time, then the sale of the mortgaged property becomes absolute. And the third is um, usufructuary mortgage. It keeps the legal right but not the physical possession of the asset to the lender. Fourth is English mortgage. It means the retransfer of asset upon payment of the mortgage money. Like before giving the mortgage money, the physical possession of asset is with the lender. Fifth is mortgage of deposit of title deeds or equitable mortgage. In this, a person delivers the documents of the title to create a security. The physical possession is not there, but the documents are given to the lender. What is pledge? Pledge is bailment of good as a security. Ownership is not given, but only possession is given for movable assets. Okay. What is hypothecation? Hypothecation is charging on any movable property created by borrower in favor of a secured creditor without transfer of possession. Charge on any movable property created by a borrower in favor of a secured creditor without transfer of possession. Mortgage of movable property. It is only obligation to pay money, not interest. I'm not able to understand it. Let's search it. It's hypothecation. Okay, the asset is basically pledged as a collateral, and the owner keeps the possession, but the lender can seize it if the borrower defaults of the loan. So yeah, basically possession is with the owner, but the lender has a full right to seize it at any time if they default. Okay, now what is banker's lien? It is basically banker's right to retain assets from the debtor until the due debt is paid. What is set off? Set off is the total or partial merging of a claim of one person with another on counterclaim of the latter against the former. Like for example, if I owe you 100 rupees and you owe me 50 rupees, then in total you owe me 50 rupees. This transaction is known as set off. Now we will know about the important sections of RBI Act and Banking Regulation Act. So first starting with RBI Act. RBI Act was formed in 1934 and there are total 61 sections, and the first schedule defines the four sections under which the Indian state should come. Now we will learn about the few important sections for our exam. First is section 4. It deals with the capital of bank, which was 5 crore at the start. Second is no, section 5. Section 5 deals with increase and reduction of share capital. Section 6 deals with permits related to RBI to open offices, branches, and agencies all over the country. Section 7, this the this states that the central government may from time to time give directions to the banks as it may, after consultation with the governor of the bank, consider the necessary considered necessary in the for public interest. It was first used in Government of India versus RBI Act in 2018. Section 8, it deals with the composition of central board and term of office of directors. Section 17, it describes the basic functions of RBI. Section 20, it tells us about the obligation of RBI to deal with government. Section 21, it tells that the RBI has the right to transact the business of Government of India. Section 22, RBI has the right to issue bank notes. Section 24, it states about the denomination of notes. The lowest note is of 2 rupees and the highest is of 10 rupees. Section 25, it tells about the design, form, and material of bank notes, which shall be and may be approved by the central government after recommendations from central board. Section 42(1), it defines the cash reserve ratio. Section 42(6), it states the requirement of a bank to become a scheduled commercial bank. It further says that the bank should have a paid up capital of not less than 5 lakhs and conduct of affairs of the bank in a manner which will not jeopardize interest of depositors. Section 45(1), I think it is I, Section 45I. It defines NBFCs. Section 45ZA, it defines inflation target. Section 45ZB, it defines the constitution of MPC, Monetary Policy Committee. Why does this hang so much? I don't know. Okay. Now next is Banking Regulations Act 1949. Yeah. Banking Regulation Act 1949. It has 56 sections and it is developed divided into 11 chapters. The RBI Act had 61 sections. Now, out of this, I think only one, two, three, four, five, six, seven, eight sections are necessary only. First is Section 7. It means that the use of word bank, banker, banking, or banking company is very important, and every banking company must use the name bank. Section 10 BB, it tells us about the power of Reserve Bank to appoint chairman of board of directors appointed to appoint chairman of the board of directors appointed on a whole time basis or managing the director of a banking company. Section 11, it is the requirement to maintain minimum paid up capital and reserves. Section 22, it talks about the licensing of banking companies. Section 24, it tells about the statutory liquidity ratio. Section 26, the return of unclaimed deposits. Section 35A, the power of Reserve Bank to give directions. Section 47A, the power of Reserve Bank to impose penalty. That is all with the Central Bank of India. Okay. Yeah. Next will be financial institutions. In this, I will discuss Exim, NABARD, NHB, SEDB, IRDAI, SEBI, IFSC, and NAFED, PFRD. In a little bit detail, yeah, that is all. So, okay. Okay, so starting with Exim, Export Import Bank of India. It was established in like the Act came in 1981, and its operation began in March 1982. It is headquartered in Mumbai and fully owned by Government of India and regulated by RBI. Its function, like its basic function, is to create export capability by arranging competitive financing for export size scale. Its functions are financing exports and imports, financing for importing capital equipment and other machinery, lease finance for importing capital equipment, financing export projects, giving line of credit. Line of credit means loan that lets you borrow money up to a preset limit. It also has refinances in foreign exchange by obtaining bulk loans in foreign currency. Contribution to equity fund also provides consultancy services, also provides discounting facilities for export bills. That is all. Next is NABARD. NABARD is National Bank for Agriculture and Rural Development. Its act came in 1981 and it is fully owned by Government of India as well. It was recommended by B. Sivaraman Committee on July 1981 and it started with an initial corpus of rupees 100 crores. Its three basic functions are development functions, supervisory functions, and financial functions. Development functions basically it provides district level credit for banks, trains handicrafts and artisans, and looks after farmers, producers, organization. So basically developing the whole agriculture and rural areas. Second is supervisory functions, like it is the sole supervisor of RRBs, regional rural banks, and also the cooperative banks, and it also helps in in practicing sound banking practices, and also onboards them with core banking solutions. So basically supervising RRBs and cooperative banks. And third is financial functions. It creates funds like Rural Infrastructure Development Fund, NABARD Infrastructure Assistance Fund, all this. Now there are seven subsidiaries of NABARD. First is NABARD Consultancy Services. This is a wholly owned subsidiary of NABARD. It was set up in 2003 and it gives consultancy needs for rural sector, and it is taken like its services have been taken by It is in short known as NAPCONs, and the services of NAPCONs has been taken by agencies like state government, banks, national, international agencies, corporate entities, etc. Like it basically provides its expertise and has its own specialists. They provide consultancy needs to the rural sector. Second is NABARD Financial Services, NABFINS. It is a public limited company. It provides microfinance to to self-help groups through business and development correspondence. It was started in February 25th, 1997 as an NBFC. The main objective is to provide financial services in agriculture and microfinance. NABARD holds 67% of equity. Let me just highlight all this. Uh, Okay, yeah, okay. It was started as a NBFC in 25 February, and main objective is to provide financial services in agriculture and microfinance. NABARD holds 67% equity, and other shareholders are Government of Karnataka, Canara Bank, Union Bank of India, Bank of Baroda, Federal Bank, Dhanalaxmi Bank Limited. This is the function of NAPFINS. NAPCONs also set up for set up in 2003 and consultancy needs for rural sector. Yeah. Next is NAP Kisan Financial Limited. It is Agri Development Finance Limited incorporated. Okay, yeah. Earlier it was known as the Agri Development Finance Limited, Tamil Nadu, and it was incorporated in 1997. Later on, it was known as NAP Kisan Finance Limited in 2014. It gives special focus to finance produce organization, and NABARD holds 86% of its equity shares. Next is NAB Samruddhi Finance Limited, NSFL. It is formerly Agri-Business Finance Limited. It was earlier, and later on, it was incorporated under Companies Act 1956 on 17th February 1997 and registered as NBFC with the RBI. It has been promoted with equity participation from NABARD, Government of Andhra Pradesh, Telangana, Andhra Bank, Canara Bank, and others. The objective is to provide credit facilities to individual and other legal entities. Basically, it provides credit facilities. Next is NAP Foundation. NAP Foundation is a Section 8 not for profit company. It is fully promoted and owned by NABARD to execute development projects across the country, either on its own or in partnership with other stakeholders. It was formed in August 2019. It is a very new. NAV Ventures Limited is a wholly owned subsidiary of NABARD with target of corpus rupees 500 crore INR. It funds uh, it's the fund focus on investment in early to mid stage startups in agriculture, agritech, agri agribiotech, food agri, rural fintech, rural business, and all this. So basically, it provides investment. Next is Sanrakshan Trustee Company Limited. It is a wholly owned subsidiary of NABARD with authorized capital of rupees 100 crore. NAB Sanrakshan aims to carry out credit guarantee and related activities towards sustainable and equitable agriculture in the rural development. Yeah, that is all with NABARD. Next is NHB. NHB is a national housing bank formed under the chairmanship of Dr. C. Rangarajan on February 28, 1987. Then it was set up in 9 July 1988 under NHB Act, which was passed in 1987 itself. It is under the Ministry of Finance and head office is in New Delhi. Its mission is to harness and promote market potential to serve the housing needs of promote the market potential to serve the housing needs of all segments of population with focus on low and moderate income housing. Its basic functions are promoting and developing the housing sector, regulation of housing sector, and also sustainable financing of the housing sector. The major government of India schemes for by the NHB are Pradhan Mantri Awas Yojana and Rural Housing Interest Subsidy Scheme. Next is SIDBI. SIDBI is Small Industry Development Bank of India. It was set up in 2nd April 1990 under the SIDBI Act, which was passed in 1989. Its function are financing the MSMEs, supporting small scale industries, supporting the Indian startups. MSME sector actually provides contributes about 30% to Indian GDP and also contributes about 50% to Indian exports. So this is a very important. So this is very important bank for that sector as it supports them. And some of the major initiatives are SIDBI Startup Mitra, SIDBI Udyami Mitra, and Mudra Mitra. Next is IRDAI, Insurance Regulatory and Development Authority, established in 2000. It was after the recommendation of Malhotra Committee report on 1999. It was developed for overall supervision and development of insurance sector in India, and its headquarters is in Hyderabad. It issues the license for new entities for insurance sector. Yeah, its main responsibility is granting, renewing, and modifying and spending the registration certificates for insurance companies. Granting, renewing, modifying. Second is protecting the interest of policyholders. Third is regulation of insurance sectors. Next is SEBI. SEBI is Securities Exchange Board of India. It was established in year 1988. It comes under the provision of SEBI Act 1992. The main mission is to regulate and look after the development of securities market in India. The major functions are promoting and developing the stock market. The second is regulation of the stock market, and also third is investor protection. Next is IFSCA. IFSCA is International Financial Services Centers Authority. It was established under 27 like it was established on 27th April 2020 under IFSC Act passed in 2019. It is headquartered in GIFT City, Gandhinagar. Its function is intra-regulatory condition for the ease of doing business (EODB). It can integrate global economy and bringing foreign funding for startups. International Financial Service Centers Authority. IFSC. Next is NAFED. NAFED is National Bank for Financing Infrastructure Development. Its bill was passed in 2021 and it was set up as the principal development financial institution for infrastructure financing. It is regulated by and supervised as an all India financial institution by RBI. Its financial objectives are directly or are to directly or indirectly lend, invest, and attract investment for infrastructure projects located entirely or partly in India. Development objectives include facilitating development of market for bonds, loans, derivatives for infrastructure financing. Last is PFRD, it is Pension Fund Regulatory and Development Authority. Its function is to promote old age income security by establishing, developing, and regulating the pension funds. Yeah, this is done. This was all regarding this chapter for financial institutions, and these were all of the financial institutions which are required in our exam. I think there were eight, no, nine of them. Okay, that is all.